Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Ken Van Leeuwen, founder and CEO of Van Leeuwen and Company, to discuss financial planning in an inflationary environment. Ken, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. Great to see you.
How should advisors be calculating retirement income in this kind of environment?
Well, Jill, this is the million-dollar question. I mean, I think one of the things with all of us advisors is that we should be using at least at a minimum of a 4% inflation rate when factoring in income needs for our clients. I mean, historically, it's averaged at about 3.73 for 78 years. I mean, that accounts for last year, but also those the early 80s as well. So we think it's a good number to use, that 4%. And we've always used that in planning for our clients.
Is it possible to get too conservative as one goes into retirement?
See, Jill, one of my big things is that it is actually, because one of the things is that the key things, right? People are living longer. They're going to need their money for longer. And you never want to experience that feeling of running out of money or that you can't buy things that you need, right? Or having to cut back on what you need. It's a clearly evident picture right now, right? People who were too conservative don't have the amount of money. Plus, banks aren't paying anything, CDs, money markets, things of that sort. So you have to be an investor even still.
And how important is it to prepare a budget in inflationary times and continuing to invest even in an environment like this?
Well, we think a budget is always super important as financial advisors, of course, right? But most people, frankly, probably don't have a budget. But really, is that what you should never do is you should actually cut back on your current spending, but don't cut back on your investing dollars because you're going to need your investment dollars for the future. Unfortunately, that's what happens in an inflationary environment. People keep spending the same amount of money. As we know, gas is expensive, groceries are expensive, everything's more expensive. And then where do they take that money from? They take it from investment dollars. So we don't want to see that. We'd actually cut back your current spending a little bit. And actually, if you can, even put more money to work in savings right now, especially with the market low. So I think it's really a good time to be a buyer if you have a long-term perspective, as we do for our clients.
Right. And speaking of buying, what about tactically taking losses on some of those profits that you would have made, or if you just want to get out of a position?
Well, see, this is one of the good things when you get volatile times like this is if you have losses, Jill, make sure you take them. And then if you swap into something else that is that like kind of company, for example, simple one, right? If you have AT&T and you own it at a loss, buy Verizon, very similar company. You get the loss in AT&T, you book the loss, and now you're still exposed to cell phone service, right? So in effect, you're maintaining your position, but what you've done is you have a tax loss, and those losses can be very valuable for use in the future. So again, there is that little bit of silver lining in this volatile environment that we're in the middle of right now.
Right. And, when we talk about continuing to invest, whether you're starting a new position or just, keeping along with what your portfolio is designed to do, what areas of the market are you looking in? You had mentioned AT&T and Verizon. You could also think about the dividend theme there. So where are you looking in the equity space?
Well, right now we're really looking at, the good old conservative guys like your AT&Ts, like your Pfizer, like your pharmaceutical stocks that pay dividends, like your Verizons. Oil stocks used to be that stock. I mean, here we have Exxon today crossing over 100 for the first time in, almost 8-10 years. The perspective of it is, look at stocks, dependability of cash flow, good balance sheets, dividend payers, really what we'll consider value plays, not necessarily that growth play where we're so concerned about what interest rates are doing. Just the steady Eddie payers, frankly, is what we're looking at. Definitely.
Anything in fixed income yet at this point? I mean, it's had a tough year, one of the toughest years.
Yeah, that's why but it's been a tough year in fixed income, to be sure. High yield muni has relatively looked very attractive in the last month. because of course there's always the need for people from tax-free income, and high yield muni has been one of the best fixed income classes for us in this last month. So I would look at high yield muni. I might even consider floating rate bonds a little bit also. I would always do these, Jills, in a mutual fund if you need to do it, rather than picking just one individual one. You know, and there's plenty of portfolios by all the big major and mutual fund companies, plus your advisor can help you look for those as well.
All right, Ken, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino.
Got it.
You got it. Thank you so much for
Thank you.
joining.
You betcha.